We certainly, hopefully you're going to get a lot of really good information tonight on what's happening. As Matt mentioned, we do have some sponsors, so we do want to thank some of our sponsors for sponsoring us. Spiro Woodward is a local attorney firm. I don't think anyone's here from the group, but they do a lot of real estate law. They're based down in Redondo Beach on Torrance Boulevard. UDirect IRA, Jeff's not here, no. So UDirect IRA is a self-directed IRA company. So if you have any interest in using your IRA to invest in real estate, there's some information on the back about them. The Note Assistance Program is Jennifer. Hello, Jennifer. So if you have some interest in investing in notes, talk to Jennifer after the meeting.
There's actually a note lab coming up in February that I went to that I thought was really valuable that they put on education. So, if anybody's interested in actually learning about notes, it's a valuable thing to go to for sure. So Jennifer, I think, if you guys want.
Yeah. Walker Dunlop is a commercial lender, and knowing Andrew will probably be here right when the bar tab opens. So if you've got some interest in that, after we're done here, we have the patio reserved at North Italia, which is just on the other side of the courtyard. So please don't, when everyone ends here, don't run to your car and leave. You're missing one of the best part of FIBI, which is the networking. So we buy the food, you buy your own drinks, but come network with people over at North Italia when we're done. Civic is a lender. There we go. Yeah, so we've got they're a local. Actually, you're kind of a West Coast brand, but we've got a local rep here. So if you're looking for some interest on hard money, either on single family or multifamily, right? Go talk to those guys.
Like 15 states too. So.
Yeah, about 15, mostly on the West Coast, but not just here in California, all over the West Coast. New Western is a company that does wholesale on steroids. So they've got some information back there if you're looking for property, single family and some multifamily. And then of course Keller Williams gives us this great room for free, so we always like to thank them for allowing us to use the space. As Matt mentioned, Jeff Walker, where are you? There he is. So we have our newest chapter is FIBI West Side. Their first meeting is January the 30th. Jeff, anything about your group you want to talk about real quick?
So very similar to this group, except our focus is on the passive investor. So our first meeting, we meet at the Doubletree Hotel in Culver City, right where the 90 and the 405 freeways meet. There is an optional no host dinner with the speakers beforehand. So you come, we all eat dinner together, you order what you want, you pay it yourself, and if you come to the dinner, you get free parking at the hotel. And of course, get to ask questions to the speakers, and then we go into the ballroom and have our meeting, and then we do networking afterwards at the bar of the hotel, similar to what we do here in El Segundo.
Way to be original, Jeff. You just copied everything we did.
Our first time.
Yeah, same time, right?
Dinner's at 6, and then the meeting is at like 7:30.
So dinner at 6, meeting at 7:30. Everything is up on Meetup. So obviously you got to our meeting here as a Meetup. Just do a search for FIBI West Side or Culver City, and you'll find the information on the January 30th meeting, and also on Christina's meetings as well. And we also, if you're new to FIBI, we have a chapter in Matt runs one in Long Beach and Cerritos. We have a chapter down in Orange County. We've got a chapter out in Coachella Valley. We've got one in Bakersfield. And then, who am I missing? And then we've got a new chapter that actually we're opening up in Kansas City. So we've got we're starting to expand beyond California as well. Our meeting for next month, which I think just went up today, we're doing a panel that's called Big Profits Based Off of Short-Term Rentals. Who here has heard of Airbnb? Okay, good. So, and actually one of our panelists, Kyle Mealy back there, Kyle, raise your hand. Kyle is one of our panelists for next month, which always warms our heart when we've got panelists that are sitting out in the audience. It's going to be a great meeting. We actually did this topic last year and got a great crowd, got a lot of great feedback for it, so we're doing it again this year. We're very close to booking someone from Airbnb to be a part of that meeting, so that should be a great perspective to kind of hear their point of view on where they see the market going and with all the local market regulations. And the gentleman that we're talking to is actively dealing with local communities on how to how to somehow find a responsible way for them to do their business. So I think with that, we're gonna go ahead and launch into it. We've got a really exciting panel tonight, like we always like to do. We like to kind of get 3 different perspectives on the same topic. So, why don't you guys start off, give a 3 to 5 minute introduction on who you are, and talk about what you do on a daily basis and how you're touching the opportunity zone. Peter, why don't you go first?
Okay, I'll start. My name is Peter McNeil. I run a tax practice locally. I'm also an investment advisor. So I deal with my tax clients to help them save money. And then I also deal with my clients to help them invest in the best ways. And basically, I think this is a great opportunity. I'll be talking more about the tax aspects as we go along, but that in a nutshell is my practice.
I asked someone that I know about, being on this panel, and they were like, look, I appreciate you asking me, but the guy you need to ask is Peter McNeil. And when the first time I called Peter, Peter's like, I have thrown myself into the opportunity zone. So, and I can't tell you how much it's restrained him to not walk you through a PowerPoint presentation tonight. He really wanted to do that, but I said, no, we're unplugged. But Peter's got a lot of great information tonight. So, and Peter actually recommended Keith come on the panel as well. So Keith, please introduce yourself.
Thank you. Keith Holland with KBS. I don't know if you guys are familiar with KBS. You'll see our name on buildings, but we are a national owner-operator of mostly office, but pretty much all asset classes. We manage 6 public non-traded REITs. We have 1 public REIT in Singapore. It adds up to about $11.4 billion in assets under management with about 100,000 investors that we've raised through our retail broker-dealer, Peter. And our focus this year has been, opportunity zones and Delaware statutory trusts, which are 1031 type product DSTs, and we've been waiting for the tax code to actually change so they work. So we'll talk more about that as this panel goes on.
Awesome, thank you. And then Peter also recommended Catherine. Catherine, how do you know Peter?
That's funny. Peter is my husband. I'm also an attorney at the law firm of Jeffrey Mangels, Butler & Mitchell, which is based in Century City. We have offices in San Francisco and Orange County as well. I am a securities attorney. So, and for 40 years I've been representing people who are raising money for, a lot of it is raising money for real estate development. So opportunity zone, for me, that's a new capital market. That's why I'm interested in opportunity zones. What I do is help developers put their documents together, form them in the correct way so that they meet the regulations, and help them go out and, I don't help them find investors, but, assist with what they need to do in order to find the investors.
Thank you very much. I'm looking forward to this panel. It's going to be great. So I have so many investors that are like, I need to find out about this. What's going on with Opportunity Zone? So it's going to be pretty exciting. I'm Matthew Owens, and I am a fully licensed CPA, Dave. And I'm better at golf than Dave too, by the way. So with my handicap, but I premised it with the handicap. Don't worry. So
Handicap is the right word.
Yeah. Anyways, so you can tell that we give each other hell all the time. It's awesome. So I'm a full-time investor. I flipped over 700 houses. We flip about 5 a month. Right now, I own a management company and a brokerage out in Tennessee. I also lend out a lot of capital in different markets around the country for different flippers. We have about $10 million lent out right now, and we're in the process of putting a $20 million debt fund together. I do a lot of value-add multifamilies as well, where we buy and renovate them and then either flip them or hold them long-term. And then we do some short-term rentals and help rent FIBI. So it's a lot of fun, and I'm sorry guys, but accounting is horrible compared to investing in real estate. Unless you're focused on opportunity zones, that you're like looking at these new ideas of strategies to help a lot of people, it's really interesting, especially if you couple them with the DSTs. So it adds that much more value to those things that add, that are tough for 1031 exchange investors quite a bit. So.
And my name's David Coe. I am a local agent here at Keller Williams Beach Cities. I got a team. Actually, Lewis, where'd Lewis go? Lewis was here a while back. So our focus is single family, some smaller multifamily. We cater to investors. So if you guys are investing in single family, we'd love to meet you. Find us after the meeting. I'm also a partner in a development project out in North Hollywood, and about halfway through our process of getting ready to build, we found out that 10 of our lots were in an opportunity zone. So I became very interested in opportunity zone about 3 months ago, and I was like, hey, I should slap together a panel. And we just found some hacks off the street to come be a part of a panel here. So no, we're really excited. Again, this is a great panel to open up the year, and you know, I think we're all getting a lot of great information tonight. So first question, and Peter, I'm gonna kind of let you get started on it. Just talk about high level, what is an opportunity zone and how they came about?
Okay, an opportunity zone, part of the IRS code, and they set a group of rules about what the income is, the economic profile of an area that would qualify. Then the law let the governors decide under those parameters what zones they wanted to create. So in California, the governor decided on the zones that are in California. The governor of Tennessee decided on the zones in Tennessee, for example, all the way through. Now that's what they did, and this was designed to encourage development and growth inside of these economically disadvantaged zones, quote unquote. The one thing though, this was based upon the 2010 census, so a lot of areas that were economically disadvantaged, like Brooklyn, New York, is now gentrified, and that's an opportunity zone, okay? So there's some areas to invest that we already know they're great economically. We don't have to take some of the risk. So will this do what it intended to or not? We don't know. Now, in order to get it, take advantage, you have to buy the property, and then you have to improve it as well. So if you buy a property for $1 million, you got to improve it by $1 million. Now there's a caveat. Land and building, you only got to improve by the building value. So if it's 700,000 building, 300 land, 700. So significant improvement, okay? So that's important. So that's what it was designed. Now, how do we get the investors? The important thing about for you guys, you may be the investors or you'll be the developers, I don't know. If you have a capital gain, I will defer your entire capital gain that you put into your fund, dollar for dollar. So if you just had a $100,000 gain, you put it in an opportunity zone, there's no tax on that $100,000 until the year 2026. A big deferral. And if you hold it that whole period, we've got other step-ups, so only 85% of the original tax will be due then, assuming tax rates don't change. The other thing, and at first I said, okay, this is nice, but for my really sophisticated investors, this is the big item. Whatever I put into the opportunity zone, any gain on that initial investment, if I hold it for 10 years, totally tax-free. It's not uncommon for something to triple in value after 10 years. So if you invest $100,000, it becomes worth $300,000, you'll have a $200,000 gain. That's $200,000 tax-free, okay? 1031 is only deferral. Here you're getting something tax-free. We'll talk later about advantages and disadvantages between this and 1031 exchange. That is the big deal. We're going to talk more in detail later in the night, but those are the big bullet points to take away about how this works.
So Keith, I know your company is looking well beyond California. I mean, these things were created to help spur development in these underprivileged areas. When you guys are looking at different areas, and you know, like Peter mentioned, there's some areas out there that aren't very underprivileged but are opportunity zones. What kind of things are you guys looking for in a project? What kind of areas are you looking at for your projects?
Let me give you a very long answer to that, okay? Because if you look at projects, and I was telling the story before we started to one of the people in the audience. In about March of this year, I got a call from a broker on a multifamily project in Phoenix, Arizona. So I'm looking at it, and you know, you look at does the real estate work? So I'm looking at the numbers, and I said, you know what, you're just overpriced. You know, what you're trying to build costs too much for market rents, don't make sense on a development yield, it doesn't work. And then while we're chatting, plug in the address into the Arizona Opportunity Zone map, and it's in an opportunity zone. I said, oh, well, wait a minute. Did you realize you're in an opportunity zone? His answer was, what's that? It's one thing that your development yield pre-tax doesn't work, but when you look at that same yield post-tax, all of a sudden it starts to make sense. He had no idea at the time. And if you look at offerings, and I probably get 500 offerings a day from the whole brokerage world, you know, if you look at it, you know, most of them, everything looks good on paper.
That's a good deal for you there, man.
Right. Very few of them said in March, opportunity zone investment, you know, on the front brochure. Now, if there's a deal, everybody's woken up to it. So you're finding those who didn't know quickly know, and they quickly marked up those assets because now it's an opportunity to sell the dream instead of build it and take the risk. So it's going to be difficult going forward. There's 1,000 groups or more out there seeing the same opportunity, thinking, oh, we're going to go raise money. This is going to be the holy grail. We're going to invest it. And the problem is everybody's going to overpay because there's going to be too much money. Because if you think about the last 10-year economic run, you know, 1031s, DSTs were great, you know, for deferral for real estate, but there was no 1031 for stocks, bonds, or bitcoins, name every other asset class, and now there is. So there's going to be, and now after a long run, you're going to find investors, especially over this past few weeks, watching the stock market drop as much as it did, start to panic and want to take chips off the table and reinvest it somewhere. Well, here is going to be their opportunity. The problem is they're going to be making a tax decision and not an investment decision. And that's a big mistake. The real estate has to work first. So most of these funds, and the big ones, institutional guys are all looking at Brooklyn. You know, there's actually surprisingly an opportunity zone in New York City, which is beyond me. But they're looking at major cities and major markets. Well, all the capital is going to chase it. So what I'm looking for, secondary markets and tertiary markets, where not only do you buy things that make economic sense, but the cities are getting much more involved in helping. You know, there's no timing issues because they want to get it done. I'm looking at a deal in Montrose, Colorado, where the city will pay 20% of the vertical development costs. That's how badly they want the investment in town. So you've got to look at market by market to make your decision, and you've got to worry first that it makes real estate economic sense, and then make the tax decision, not the other way around.
So Catherine, I mean, you've been setting some of these things up. Like, what is it about an opportunity zone fund? Like, what is it? Like, how what's it comprised of? Who can start it? What does that look like?
Okay, so an opportunity zone fund is either a partnership or a corporation. It's got to be one of those two things, and it could be set up by anyone, and any third party, any person, any individual can set up one of these funds, and all you have to do is file a form declaring to the IRS, this is an opportunity zone fund. We intend to comply with the requirements to be an opportunity zone fund. And those requirements are that you have to have the intention of making an investment in qualified opportunity zone property. And that intention has to be fulfilled within a period of at least 31 months from the date that you first put your capital in. You have to have a written business plan as well as a written schedule for how you're going to deploy the funds. Interestingly, you do not have to actually identify the property that you're going to develop or buy as of the date you make your election. As long as you fulfill the 31-month deployment criteria, at least for now, there are no regulations that say when you're required to identify the property. So when you're forming an opportunity zone fund, as long as the individuals who are qualified to receive the tax benefit invest in the opportunity fund within 180 days of the date of their gain, they met that requirement. Now it's up to the opportunity fund itself to meet the 31-month requirements that I just discussed, so I'll stop there.
So what you're saying then is they put their money into this fund that's created already within 180 days, and a bunch of investors can invest together in it's basically a syndication license with the SEC and things like that, just like a normal syndication is. And then after they put their money in, you have 31 months from the date the first person put their funds in, or is there multiple people coming in putting their funds into? I would assume there's multiple investors,
Right.
and then you have, and then is it, when does the date start? You said it's 31 months from when they,
31
from when they put their money in, or from when the sale happened for that particular
So
investment?
when they put the capital in, that's the 31-month starting
Okay.
period. Yeah, now, there may be some regulations that further refine this, but as of now, that's what we know. And by the way, this fund doesn't have to be owned by a lot of people, doesn't have to be syndicated. It has to be, if it's a partnership, it has to be at least 2 people.
Okay,
Because that's
right.
required to get the, to be.
So you
a
could do one
tax
yourself or
partnership.
something like that if you have enough capital.
Absolutely. An
Okay.
individual can do this on their own if they want to.
That's pretty amazing, because if you
Yeah.
think about the requirements for a typical 1031 exchange and how short of a time period it is, you have a distressed buyer situation, because if you have major time there. So pretty much, I don't see a reason why, like, pretty much most 1031 exchange investors would be wanting to put their money in, and like you're saying, in the stocks and bonds aspect, and, you know, other investment asset aspects that haven't been able to ever do a 1031, that's huge. But you can see it being a big issue from the return on investment standpoint, like you're saying, because most of them aren't gonna pencil. You know, people are buying these things for tax benefits, like you're saying, and not having that pencil right. At the top of the market, we may not have major gains on some of those, unless you really do hold it for 10 years or longer, if we're in the down cycle and you gotta wait for it to come back. But what do you guys think about the timing of the market on that type of thing when you're dealing with, you know, these opportunity zones and, you know, I would think, like you said, it has to pencil from an equity standpoint for the timing of the market first. I can see a lot of people getting harmed if they don't do this right, and you get a lot of people looking for, you know, stupid money coming in, right? Does that make sense? What do you think, Keith? What are you seeing?
Well, again, if you overpay upfront for the property and you've got 10 years of a hold, you expect certain growth, but if you're digging yourself out of a hole to start with because you overpaid on the asset, you know, what price does it end up being 10 years from now? Who knows?
Right.
What you don't wanna do is end up paying the tax, having zero gain, because what you've done is you put money that's not at work to work, earning at what, 0% return, for the benefit of 7 years of deferral and a 50% step up in basis. You gotta run the math on all of it, and there's gonna be different answers, but go back to the statement or the question that you had asked about timing. These are some of the things that we're waiting for, those who are, like ourselves, are trying to come out with a fund for multiple investors that you raise over time.
Right.
The timing of different investors, that's what hasn't been worked out in the current draft of the code. That's what we're all waiting for.
I got you.
So the single asset deals work, you know, small crop, you know, fundraising works. But if you wanna raise a major fund, and what you want to do when you do this stuff is you want diversification. You want to have, you know, as many assets as you can, so bigger is always better. But they haven't worked out the timing to make it all work yet.
And Peter, you know this from a tax standpoint, if they go put their money into the fund and can't find an asset, is it just automatically then 1031, you know, it's taxable then if they can't find their asset in an opportunity zone, you know, and they put their money in the fund initially and check the box, you know, saying they're gonna do this? It's just
Yeah,
not
you want,
taxable.
it's fine. Yeah, you'll just wind up paying the tax at that time, you know. What you don't wanna do is put it in like your own LLC, and then you never develop it. Then we're worried about it, they're gonna go back and hit you with, oh, this tax should have been paid in the 2019 tax year, and now it's 2022 and you failed. Are they gonna go back to 2019 and assess penalties and everything like that? We don't have regs on that. I think they will have regs that say penalties will be hit if you don't do this. What I think, now, if you're going with a promoted fund, then there's gonna be penalties for not making it that the fund will pay, and that will just be an expense against the fund, I'm thinking. Unless they totally fail and they go out of business, they'll just pay the penalty for not putting everything in, and it's gonna be 5% of the assets raised, divide by 12, that amount every month.
Okay, and how does it work from a semantic standpoint when you're dealing with, you know, you close escrow on your property, is the same thing as the 1031 where it has to kind of go to an intermediary first before it goes to the fund, just like a normal 1031 exchange?
No,
or
there's no intermediary. That's what's great about this. You just have to get it invested within that 180-day period into a fund. Then you get the deferral, okay? You can even do multiple funds. So what I'm looking at, by the way, one of the things we didn't say, 180 days, it's 180 days if it's inside of a partnership, like maybe you guys had your assets inside a partnership. A lot of you might have family limited partnerships. 180 days from the end of the tax year of the partnership, not the date the gain happened, okay? So you got 180 days, you put it in, you get the deferral. We don't have to report that income. I'm gonna show it on the tax return, capital gain, less exclusion, code section 1400C. And we're done, and that's how you get the exclusion. And then we wait and we hope it performs well.
So what does that tell you? You should do all this stuff January 1st? And then 180 or a year and a half to get there.
Very interesting. And, we have questions here in the audience, I see a head, no. Anybody have questions? Please.
One specifically, three specifically. I'm sorry, Keith, what did you just say, do it on January 1st and you have a year and a half?
Well, he said it's 6 months after the tax year.
Right.
So the tax year ends December 31st. So if you did something January 1st, you have the whole year plus 6 months.
To identify the fund that you're gonna.
That's question number one. Question number two was for Catherine.
Okay.
I'm sorry. You have, does the timing of when you take the money out of the market and then put it in the fund, does that have to coincide? Do you have to take it out of the, like if I took the money out in September, and before it was even a fund invented, and then my brother and I invented a fund today, can we put the money in and then declare retroactively that's part of this fund, that was meant for this fund, so there's no taxes on that?
Yeah, and it's not retroactive, it's like, when you realize your gain, that's the day that the 180-day clock starts. You got 180 days to decide, where am I gonna put this? Am I gonna form my own fund? Am I gonna put it in someone else's fund? It doesn't matter.
Okay, and then the third question is for Stephen. This is the date. So, 2010 census. The next census is in 2020. If they then say, well, it's not an opportunity zone anymore, that's not a downtrodden area, is it retroactively going to be excluded from the?
No.
Okay.
Add 5 years to 2020. 2025, you have till 2025 to invest in that zone, the old zone that got killed.
Nice.
After 2025, you gotta use the zones that were created from the 2020 census.
That will mean that we probably see increases in costs in those zones that we know are gonna get killed, because they'll probably already be.
They're probably already up right now. I mean, for the most part.
The ones that got killed is Brooklyn Central.
Maybe.
I have a question. So I bought a property earlier this year, April, and it's in an opportunity zone. And I have not filed my tax return yet, right? Could I indicate that it's an opportunity zone investment, even though back then the intention, we already syndicated investment, by the way. And can we still characterize this as an opportunity zone fund? Can I, get a vote amongst investors, is everyone on board to do this for that purchase in April 2015?
I mean, theoretically, it would be possible, but the only people who are eligible to qualify for these tax benefits are those who invest their capital gains. So if you have investors that they didn't invest capital gains, they have zero
They may or
benefit.
may not, right?
So I don't know that it would work in that scenario, just because it's not gonna help them.
Let me answer it differently and see if you disagree with me. You already bought the property.
Yeah.
The fund has to buy the property. So if you set up the fund
Yeah.
after you bought it, you can't then deposit it because you can't deposit
Well,
it.
it's bought by an LLC.
No, I was bought by that
A newly
LLC.
formed LLC.
Yeah, so you're asking if that LLC can become an opportunity zone fund? Answer is yes, it could, but what about your investors? Yeah.
Everyone has to be on board.
Yeah, yeah.
Okay, on the heels of that.
So, if I'm doing a 10-for-1 exchange and I don't identify the property, I could move that money into DTS also, right? So instead of moving directly into a fund, where it's just sitting there until I identify another opportunity, could I move it into DTS, make some money in the DST, and then make money in the process until I identify it, and then move it to a fund? I don't know.
No, the code specifically says you can't make two separate elections. So you're doing a 1031 election and a 1400 election, so that will fail.
Hey, can you talk about the difference between a 1031 exchange and what an opportunity zone fund would look like?
Sure. This is why I brought my cheat sheet today. And why I hope I can find my reading glasses real fast so that I can read off the cheat sheet, okay? So I'm going to talk about advantages and disadvantages of both, okay? A 1031 exchange has to be done real estate to real estate, okay? So it's limited to only that. Whereas this can be any capital gain goes into the opportunity zone fund. Opportunity zones are not necessarily a real estate investment. You could be investing in a manufacturing company that's inside of a qualified opportunity zone, okay? So let's go to a couple of these things. One of the advantages of a 1031 exchange, we have what's called swap till you drop, which means that every time you do an exchange, you defer the gain and you don't pay it. Upon your death, if you want this to go to your heirs, there's a full step up in basis. So you've never paid the tax at all, okay? Opportunity zones, there's no step up in basis upon death, okay? However, your heirs that are going to get this opportunity zone fund will step into your shoes, and the clock that was set by you maybe 3 or 4 years before your death still keeps on ticking for that 10 years, so you can get everything tax-free on the investment. An exchange can be a direct purchase of real estate anywhere in the country, whereas for opportunity zone, it can only be an investment in the opportunity zone. Because the investments must be improved, okay? A DST, normally when you do this, you're gonna wanna get income right away. So you have a property where you may be getting 3% on your money, if it's here in the South Bay, or only 2% if it's right by the beach, or 1% if it's by the beach. Well, if I put in a DST, I'm probably gonna get 5% cash flow. It might take a month or two to have all the funds settled, but in 2 months, you're gonna be getting your cash flow. Now, if I invest in an opportunity zone, it's a development deal. It's probably gonna take 2 to 3 years of building. We're gonna have to stabilize cash flow, so it probably won't be till the end of the 3rd year or the beginning of the 4th year before you start getting cash flow from it. So that's a disadvantage to the opportunity zone. However, because of the improvement, it's gonna be on higher capital, so your distribution will likely be a lot higher once it finally starts. Okay, advantages of the opportunity zone. Again, anything. Sell your business, sell part of your stock portfolio. You can do it. You sell your personal residence. You can't do a 1031 exchange for personal residence. Okay? We've got a lot of people where maybe they want their house for $500,000. They're going to get $500,000 tax-free, and we're going to have, but the property's worth $5 million because it's by the beach. That's $4 million. I can't defer that gain. Now I can do some fancy dancing where I can convert it to a rental and stuff like that. But if I don't want to do that fancy dancing of converting to a rental and doing another 1031 and eventually doing a conversion 4 years later, I can do an opportunity zone, and that's often very good. The other thing is I only have to invest the gain if I'm doing an opportunity zone. Sorry if I'm going a little long, guys, but this gain, if I sell something for $1 million and I have only a $300,000 gain, I only have to put the $300,000 in and pocket the $700,000. Use it for whatever I want. 1031, I got to put the whole $1 million back in. Okay. Also, those of you who've ever done an exchange, the fastest 45 days in your life are those 45 days while you have to identify. Okay? If you blow your exchange, okay, this is great. We got the opportunity zone to save some of your taxes. Also, if you have a property inside of an LLC, the LLC or S corporation or whatever entity you have, by the way, never put real estate in an S corporation. Ever, okay? And you feel like, say, you're 3 brothers, you all own it. One brother wants to defer the tax into a 1031 exchange. The brother number 2 wants to pay for his daughter's wedding. Brother number 3 wants to pay to send his daughter to college, and both those other brothers want to pay the tax. They stop talking to each other at Thanksgiving every year. Because you got to do it's an all or nothing. You either do the exchange for the whole LLC or you don't. Now there's ways around that, but it takes 2 years by doing a swap and drop, creating a tick. This way, if you have that family situation, okay, we sell the property, distribute all the cash. The brother who wanted to defer the tax, he can put it into the opportunity zone. That's a big explanation of it. I probably didn't explain 1031 in detail. I only explained the differences, positives and negatives of 1031 versus an opportunity zone.
Awesome, thank you.
This is a question for Peter. So on that sample you said where you sell it for $1 million, it costs 700, you can pocket the 700, 300 goes to the opportunity zone. Let's use another example where you bought property for $1 million 20 years ago, you sell it for $5 million, and we took the 4
Yeah.
and put it in the opportunity zone. What about the depreciation recapture on that 20 years of depreciation? What happens to that?
Depreciation recapture related to real estate is considered a capital gain for purposes of reinvesting. Okay, so if I had you're not gonna have depreciation on a personal property.
No,
But on an income property, yeah, part of your capital gain is gonna be the depreciation recapture. Now, if I sold something that's considered personal property, like I sold machinery and equipment, the depreciation recapture on that is not considered a capital gain, and that does not qualify to go into the opportunity zone.
Okay, I guess I'm still a little lost. So on the original $1 million investment, whatever your improvement was worth 400 grand, you're depreciating that over 27 and a half years, you sold it. That comes back as you have to pay tax on that if you took the profit and put it into the gain into the opportunities.
Yeah, if you did that, even the depreciation recapture is avoided.
Wow.
If it's from income producing real estate. Now, by the way, I said personal residence versus commercial property. Remember, there's no depreciation on your personal residence.
Yeah, go ahead.
Question on, do you distinguish between the capital gains invested to purchase the property versus the additional money needed to do the improvements? Or can it be all the same, or can it be different?
What was
It's all the same, it's all the same. Everything you invest in the opportunity fund, that goes towards the qualified property, is counted towards your deferral.
Yeah, Nate.
Can you include any soft costs towards the loan costs, things like that?
The question is as part of your improvement of the property, can you include the soft cost on it? I believe the answer is yes.
Definitely. We haven't even talked about the 90% of the property has to be qualified for any of that.
We're getting ready to talk about it.
Okay.
Yeah, go ahead, Joe.
I just want to make sure that I understood this correctly originally. So you have 31 months, the fund has 31 months to deploy the capital. However, if it's not deployed on an annual basis, you do pay a small penalty. Is that right? 5% annual.
5% on the shortfall to come up to that 90% of assets to qualify.
So here's a question, and Keith, you may know this, and that you guys are looking at this project. So let's say I identify the property. Does the property have to be, like, what if you have to go through the process of entitlement, right? Maybe I find the land, and maybe a big project like the one you're looking at in Colorado, it may take a couple of years to go through entitlement. How does that 31 months impact that? What if it takes you 36 months to get the property entitled?
That's the development risk I mentioned earlier. Depending on which city you're in, some cities are very difficult to operate in. They take time. Other cities are very proactive, which is why the primary markets where they're in demand, which might be LA, it could take you more than the time you have to invest. So when you find a project, what you're seeing actually trading are those who have gone through the process at least to a certain point, and they don't have 30 months left to go. But if you don't, that's the risk you take. Again, that Montrose property that I'm looking at, not only is it all done and ready, they've already started building and the city's behind it. So again, you get different benefits to go into secondary, tertiary markets.
What if I buy a property and it takes me 18 months and now I'm in the construction phase? What if I'm not done with the construction phase by month 31? Is the fact that I'm at least improving it, will that qualify?
The big issue is you have to invest the capital, so put the
Yes.
equity in first.
Right, that's a key distinction, because you can put loans into opportunity zone property, and it's counted towards the capital appreciation. But the 31-month piece only applies to the equity portion. So you can, like you just said, you can wait to use the loan portion.
I'll give you a couple structural, features features that we're putting into our fund. One, we're gonna pay cash, so there isn't the issue about timing and putting, we'll pay cash for everything. You spend the money, you take the loan out second. And then when you leverage it, because in year 7, you've still gotta pay your stepped-up basis tax obligation, you under-lever it, so by the time you have to pay it, you then refinance it, put a normal loan on it, take loan proceeds to pay your tax obligation, so you never have to worry about saving and how you're gonna meet that obligation in the future year.
Did the lenders look at that and say, they're gonna have this obligation at all down the line that they're gonna have to pay if it's a big 85% of that tax? I would think that they might, I mean, maybe they haven't been privy to that yet, I wouldn't think, but they're not seeing
The
that.
lender doesn't care about that, he's got a low LTV going into it.
Okay.
His collateral's the property, he likes the low.
So the ideal situation from an operational standpoint, if you're looking for these opportunities, is to go through and bring them, find them, bring them through the entitlement process and get them ready for these funds to come in and pounce, so that you can take opportunity, you can take advantage of that. And then down the line, I would assume, obviously, they're all value-add projects, so, you know, you're looking at this and refinancing later. Is there any limitation on refinancing early and getting the cash out early in that case? Or is there a problem with doing that? Because if you go put the equity in, then you improve it to a point where now you have a good lender and they take out even a portion of your extra capital to pay back investors and, you know, increase the return or something like that. I mean, I don't know, where's that line drawn as far as being able to refinance?
You're a real estate owner, right? If your property goes up this much, you're gonna take out a little bit of extra equity. If it goes up like this, you're gonna refinance,
Okay.
you might get all your basis back, and, you know, in a loan distribution, that's not taxable.
And since you guys are looking at these from a long-term standpoint, you know, and saying, I'll never have to pay a gain on the asset that you're purchasing, are you guys then basically going through with some of the new tax laws, trying to write off every expense possible in year 1 to front load the depreciation aspect or the write-off of those things, because you'll never pay tax on it later, or does that decrease your basis, or how does that work?
Basically, while you're developing, you're not taking any expenses, you're just increasing the basis of the property. So then you're increasing what you can take depreciation on, right?
Right.
So the problem with this structure is if we don't borrow money, once we stabilize and you start having your first income, you're gonna have a lot of expenses in the first couple, 3 years. You're gonna have losses being spun off, because you're gonna get the depreciation. The LLC will calculate the depreciation for you. You're gonna have a K1 with a $100,000 loss, but you're gonna have no basis. So you're not gonna be able to write off that loss. It'll be carried over as what's called an at-risk loss limitation. So you wanna be careful of that. So what a lot of the people will be doing, they'll be borrowing money, because the qualified non-recourse debt adds to your basis. Now I'm gonna be able to get a deduction for the depreciation that you would have, and provided I've got enough basis, I can take that deduction. But be warned, you're a passive investor, so if you don't have other passive income, your losses could fall into that trap. Now, these losses you'll eventually get when you do have income that recaptures. But, you know, some of these rapid, we're gonna have this quick deduction, that's not gonna happen, okay?
So you're saying like the cost seg strategy wouldn't work on these types of investments where you buy the building, do a cost segregation, write off a bunch of stuff, and then now anything under $2,500, you know, for the new tax laws, there's non-capitalizable if you're able to separate some of those minor items. Obviously, if it's not improving the useful life, if you're doing a full rebuild, it's harder to say that it's not improving the useful life, right? But could you not do a cost segregation and then write off those items in year 1, or in the first couple of years, or the first 5, and front load that, and then write off a big chunk of the depreciation, or the actual improvements as well in year 1 as an expense, because that individual item might be under $2,500, or, you know, because pretty much like every window is $250, right? If you
Yeah.
if you're doing that same type of analysis up front when you're buying the building, and then also on the construction and being meticulous in your detail there, would that be of a benefit? I would think.
Okay, you as the promoter will know how much qualified non-recourse debt you have. If you know you've got enough to have given your investors a tax basis high enough to take advantage for that, then it would make sense. Otherwise, it won't. That's gonna be at the promoter level. You should be trying to make that decision for your investors. I don't know, do you do anything like that? Will you do that analysis, Keith?
I wouldn't know in the accounting department.
Actually, you have a good accounting department, I've talked with them, okay, yeah.
I have a question because you mentioned that the $100,000 loss that you have in your schedule,
K1. K1, yeah.
You wouldn't be able to write that off against anything because of the way it's structured, but normally, wouldn't you be able to write that off against any other income that you make or whatnot?
Up to 25,000 if you're not.
No, wait, no, we gotta talk about at-risk versus passive loss.
Gotcha.
If you never took the qualified non-recourse debt, you won't have any basis.
Mhm.
So if there's no basis, you can never take a loss in excess of basis. It becomes suspended, and you save it off to the side, and then when we eventually have income, we can offset that income against that loss that was not allowed.
But you can't offset it against something outside of the fund?
No, you cannot.
Even if you're, and that's the question, so you made specific, that's because of the passivity of the investment.
No, it has nothing to do with passivity, it has to do with basis rules.
There's a limitation on the passive losses, and there's also a limitation on the basis as well, as what he's saying, basically saying that, you know, you have to have basis to take the loss in the first place. And then
This
you
is
can take it
getting
without-
overly technical, I'm worried we're losing the rest of the
Sorry.
group. I can talk to you about this after the fact. I assume it's not of that much interest to some of the other people.
I have a really fundamental question, so it's a little bit different. Colin, how does an investor, such as us, how do we actually indicate on our tax return, I have taken the capital gain and placed it in an opportunity fund? And just a simple thing, but I bet you half the CPAs are not gonna know this year, especially, how to do it.
The CPAs who have attended my seminars all know the answer to that question. You just write it on Form 8949, which is the form where you put the detail that goes to your Schedule D, and you then just say, code section 1400Z, and you put a code Z in the explanation box. That's all. It's real simple.
Yeah, Kyle?
Are there the same improvement requirements for ongoing business concerns, like non-real estate assets? Do you also have to put in 100% of the, the value in improving the business asset in this case?
Yeah, Kathleen, that's a good one for you.
Yes, yeah, you do. The same rules apply no matter what type of asset you put the money into. And the rule on that is it's either original use to the fund. So you have to buy a business brand new and you're starting up that business, or you have to do substantial improvement. So if it's a manufacturing plant, you have to improve the value of the manufacturing plant itself equal to 100% of the value of the original building, or the original tangible assets, not the property.
Can that improvement include hiring employees?
No, I'm talking about tangible here, yeah, not employees.
So would it just have to appraise that amount? If for some reason I don't have to pay full price for labor or for materials, do I have to actually, if I have a building worth $100,000, do I have to show, okay, I paid $100,000 in improvements, or does it just have to now appraise for $200,000?
Appraisal. Yeah, in fact, is anybody here an appraiser in this room? There's all sorts of rooms for fraud, for crooked appraisers under this law. Yes, exactly.
Way
Not that I would
to
suggest
qualify
that.
the room before you made that comment. Keith, I mean, obviously, just from we've talked a lot about an opportunity, creating the fund, what it can do. How do you find investors for these? So, I mean, you guys are starting a fund. Like, what's the process for, like, how do you find people that are interested in investing in this? And maybe the other way, if you are an investor that has a gain, how do you find a fund to invest in?
I'll ask everybody in the audience, raise your hands if you have gains in your stock portfolio that you're afraid of losing and would like to find a place. Probably all of you, whether you're raising your hands or not. Finding people won't be the problem. For ourselves, our company answer is we have a broker-dealer, we have a retail network, we have 100,000 investment advisors that have, they work 100, 200 clients. So you put the product out there and they all have a need.
So this is mostly through stock.
Yeah. Now, what will be ideal is to go to the venture capital firms up in Silicon Valley who have all these new tech billionaires and whatnot, who are highly concentrated in one you know, all their assets in one, you know, stock that need, or now have the opportunity to diversify. So you'll go to the VCs. We have a partner in New York called Related Companies that we do our DST business with, and Related is doing an opportunity zone fund, and they've gone to Sequoia Capital. Why? Because Sequoia Capital is one of the big VC firms in Silicon Valley, and who knows how many hundreds of billionaires they know. So quick access, you can raise a lot of money very quickly. We're going to do that, and we're also going to use our retail network. But as far as where do you find these funds, they're going to be popping up like weeds. You know, everybody, I don't know how many I've seen.
Are they, because I know, Catherine, you have to register and you have to declare it. Is that public information? Is that going to be searchable somehow?
Well, the form that we filed to make the election with the IRS, that's an IRS form, so no. You could fly under the radar, and you don't have to register an opportunity fund. You can do a private fund just like you do any other private LLC.
They're all self-certified. You don't have to go to that. Anybody can do it self-certified.
So it's going to be up to the fund to be vocal, saying that we're looking for investors. If it's more of a mom and pop, someone who's not going to be
Right.
tapping a
Yeah,
large
yeah.
broker-dealer network. Let's talk about the 90%, right? Because I think, Catherine, I'm going to give this one to you, you know, because there is a certain requirement for how much you have to invest in opportunity zones, but not everything. So explain what that looks like.
Okay, this gets a little bit complicated. So it starts out with the following. An opportunity fund has to have at least 90% of its assets in qualified opportunity property. Well, that property consists of either stock or partnership interest or what they call business property, which is basically tangible property. Okay, so you're an opportunity fund. Let's say if you invest in another partnership, that partnership has to be engaged in a qualified opportunity business. That means that the business has to have at least 70% of its assets, they use the term substantially all of its assets in qualified business property. But so it's 70%. So you're a fund, your fund has to invest 90% in property, including partnership interest or corporate stock, which can invest 70% of its assets in qualified property, okay? So.
Say that again.
Yeah, I know. That's what I mean. It's complicated.
Did you bring your PowerPoint?
Right here.
Yeah, so when you're setting up a qualified opportunity fund, those are the numbers that you have to keep in mind. You've gotta have 90% invested in the property that qualifies. The property itself can be either stock or partnership interest or tangible property. And if you, by the way, if the fund invests in just tangible property, that's 90%. They gotta invest 90% in tangible property that is qualified. So those are the differences. But effectively, if you use that 90% invested in a fund that's 70% invested, what you really have is 63% of the total assets invested in qualified opportunity business property. So you can invest in other things, is what that means.
More questions? So it means it doesn't have to be real property, is that?
Does not have to be real property, right?
Question about?
So if you're investing in stock in an opportunity zone, does the company then have to be in an opportunity zone?
Yes.
Okay. So
Now, the
business
company
needs
has to be.
located in an opportunity zone.
Yeah. The fund itself doesn't have to be. The company that you invest in has to be in a qualified opportunity business. And business means one, substantially all of its assets have to be in an opportunity zone. That means 70%. There's some other rules that apply too, such as 50% of the income of the business has to be from the qualified opportunity zone. I won't get into all
Is there a
these
pie chart?
details.
You know, that actually may help a lot, like
Yeah,
later
yeah,
on, if we can
yeah,
get an
yeah.
email of like what this looks like, because what it sounds like is that if I have an opportunity zone business and, you know, it's investing in real estate that is in an opportunity zone, and I have an office that I own a commercial building in, and it's my business, and that business is in, that my office is in an opportunity zone, and you're saying my business could then qualify to sell as an opportunity zone opportunity as well as the, you know, the asset, if I have all these other assets in these different ways.
Well, there's
It's
more,
interesting.
okay, there's a further complication to all, because we touched on it slightly, but it's this. In order for the business to qualify, it has to be a new business, or it has to be substantially improved. Yeah.
So,
Can you guys all believe this is the type of pillow talk we have at home?
Well, so then the opportunity zone fund, it sounds like we can invest in, different.
Stock or partnerships or
Right.
business property.
Oh, but, for the fund, that all sounds business related or commercial related. What about just opportunity zone residential properties? Is that something that I could do with the fund?
Well, it's got to be a business, it has to be an active business. And we think that you can build multifamily, and we think that you can operate multifamily, that's a business. We think that you can build homes and then sell homes, we think you can do that. But, yeah, if you get too much into residential, question mark there, is that an active trader business?
Well, you can rent them.
So then.
Rent them, yeah, if you're renting them, active trader business for sure. Yeah.
So then it wouldn't matter if it's, 1 to 4 units or 5 plus?
Right.
Okay.
Can I make a quick comment? Kathy's talking about the type of structures that Keith is gonna have to use. He's doing a big fund. Those of you who are like small developers here, you'll probably create one LLC to develop a property, and that's all you're gonna have, that's gonna be your tangible asset. So this 70% rule won't apply to you. It'll just mean that your assets inside the fund have to be, 90% of the assets have to be qualified opportunity zone assets. So that could be a building and land. Now, when you buy a building for, say, $1 million, and it's 300,000 land, 700,000 building, okay? You've got $1 million that's not qualified because you haven't done any improvements. Now I have to do improvements, but I only have to do it on the building. So if I do 700,000 of improvements on the building, now that building that I originally bought that was not a qualified asset becomes qualified, plus the improvement. So the building is now worth 1.4 million, and it's qualified. Because you improved that building that was on the land, that land also becomes a qualified asset. So the million you originally put in, plus the 700,000, now you have 1,700,000 of qualified assets. Everything in there is a qualified asset. The only thing that might not be is cash. Now, if your cash has been designated as working capital, that it's going to be used for future improvements, that cash is also considered a qualified asset. Where we're going to have trouble going forward under this 90% test, you've got, let's say, you've done great. Not only, with only 1.7 million, you've grown this thing to be worth $10 million. How marvelous. Okay. You've got $1 million in cash which you're building in reserves because you want to make distributions. If you don't make those distributions in time, okay, all of a sudden you might fail the 90% test because you've built up too much cash. Because more than 10% of your value is cash that's not designated for improvement, but it's designated for distribution if you don't distribute it in time.
Yeah, you do a 10%, you do a big construction project, and you gotta make sure you have those kind of reserves aside anyway, so.
So just along that line you were saying, so 90% test, and so is it like every point along the year you can't dip below 90%, or is it sort of like an average across the entire year? Like you said, you might have accumulated a lot of cash, being distributed, so the percentage is actually going to fluctuate.
The rules are you have to do do this testing every 6 months. Now, it doesn't say this, but because they say that the calculation's gonna be done monthly on the penalty, the only way I know to do that is that after you fail the test once, then you gotta go back and do it monthly. Okay, so every month you're gonna do it until you pass. Now, let's talk about the crooked appraisers out there, okay? Let's say that you fail this test because of what you put in. It's not the cost basis, it's the appraised value. Let's say you put it in so the building is worth 10 million, but it appraises at 11 million. Get an appraiser to say it's worth 11 million, and you maybe pass the test, okay?
So in that case, the question that Nate asked earlier about the soft cost, that doesn't necessarily matter as long as it appraises.
Yeah.
Okay.
And I don't see anything wrong with what you were saying on this with regard to, you know, can you buy a piece of land and buy it, and build a full multifamily on the thing to do that whole, I mean, I think that'd be a gigantic opportunity, is really that, because you're looking at long-term holds on these and trying to find something that's just completely nothing and tear it down and rebuild.
Can I make one comment that I'm real nervous about? A lot of you are probably thinking, okay, I wanna create an opportunity zone, I wanna buy a piece of property, you know, and I'm gonna get this thing done in 31 months. If you are buying an unentitled property, a building or a raw land that has not been entitled, I predict a 99.93% chance of failure of getting this thing developed within the 31 months. Because it's gonna take you 2 to 3 years just to get the entitlements. If you're gonna do this, buy something that's entitled already. Or if you have it in the opportunity zone, get it ready, entitle it. You can then sell it to an LLC. If you keep an interest, make sure your interest is under 20%. Okay, I just want to make that warning to you guys, because I think a lot of you are going to be thinking about doing it. Don't buy unentitled projects, you'll probably fail, okay?
So, Peter, I know can you talk about, like, where do you find these opportunity zones? Like, as an investor, if you want to start researching this, where do you go and figure out where these zones are?
Well, there's a map that I had a link to, but it's way too hard for me to type out. I'll probably, anybody that wants to give me your card, I'll send you an email with a link to the map. And then all you do is you just drill down. You know, you say, you know, it's going to show the whole country, and then you just start zooming in until you get to California or Portland or wherever you want. Wherever your sister lives, you know, you want to say, oh yeah, you told me you're so successful. Look, you live in an opportunity zone. You know? Yeah, I mean, that's the way you can find it. Now, finding an opportunity zone investment, probably the easiest way for those of you who are not real estate developers that can develop your own, you're going to have to go to a professionally managed fund. Probably something like Keith is going to have, and if you want to do that, and I'm not allowed to say they're supposed to come to me for that, right? Because I'm not supposed to endorse my own business, but I've been researching a lot of the funds that you can invest in.
I think it's fair to say that he's probably the expert on this, so.
So, Keith, what are other communities that have opportunity zone areas, what are they doing to promote the fact that they have these opportunity zones to encourage funds coming in? I know what they're doing in Colorado is one thing. What other types of things are communities doing to promote that?
Well, every state, you know, there's one big giant map you can go to, but if you're looking for a specific state, every state also has their own map. So each state is put together and they market the fact that they've got these opportunity zones. Putting in their shopping areas, like say Brooklyn or New York, Oakland, or Koreatown here in LA, is a great opportunity for you guys that are local. We're calling it a great opportunity. You know, every city is going to take a different approach to it. Again, I'm going to use the Montrose one every time I answer because it's ridiculous. When you go and look at how much they spent in advertising, you know, not locally, nationally, because their goal is to bring businesses in, to bring jobs for employment, you know, then to build the workforce housing to go along with it. So the smaller the smaller the city or the county, the more they have to spend when they market. The bigger ones don't have to do it because the market does it for itself. You know, and if you look at the brokers have all jumped on the bandwagon and they're making it a part of all their, you know, their offering memorandums. It says it on the front cover now, opportunity zone investment. So it's out there, it's self-marketing.
So, Catherine, from a fund syndicator perspective, what type of obligations will be on the syndicator or the operator for someone who's managing an opportunity zone fund versus just a typical PPM? What other responsibilities are they gonna have?
Well, so part of the issue with an opportunity fund that's different from any other real estate syndication is that you have to have investments that are gonna be around for at least 10 years. As Peter said, in order for you to qualify for the tax-free capital gain on your investment in the opportunity fund, you have to hold it for at least 10 years. And we don't know yet what the restrictions are going to be on the distributions during that 10-year period. Fine, the income distributions are okay, but we really don't know what, if any, distributions of proceeds, of sales or refinancing. I mean, you mentioned it at one point about, potentially a distribution of loan proceeds. I don't know if we're gonna be able to do that, at least yet. The regulations haven't said anything, so as the sponsor of the Opportunity Fund, and you guys are probably thinking about this too, it's like, well, how are we gonna hold on to this money for 10 years? How is it gonna work for our investors? Maybe you could, I'd be interested to hear what you have to say about that.
Well, again, we have not come out with our fund yet because there's all these unanswered questions. You think why would they not allow you to refinance real estate and make that distribution? Because they do it everywhere else. Are they gonna change it here? I doubt it. 99% sure they don't. But what if they do?
Yeah.
That's certainly a risk. And if that's the case, you'll change the way you make your investment. You won't refinance it, and somebody who's got that tax obligation that they finally have to pay in year 7 is gonna come out of pocket. There'll be some other way we'll figure out how to make the distribution. But again, these are all the unanswered questions from an investor standpoint, which is why we delayed and actually launching RSVP. It's just too many unanswered questions.
Peter, in a 1031 exchange, is there a typical limit or amount of time you would want to let pass before you refinance and pull proceeds out on a typical 1031 so the IRS doesn't look at it funny, or is there an issue with that on a normal 1031?
Well, this is outside of this.
Right.
You're supposed to match the debt from the property you gave up to the property you purchased. In general, if I go 2 years later, I'm totally safe because the IRS says de facto, but it's based upon intent or needs, okay? So 1031, if I refinance 30 days later, that's gonna be looked upon that I took boot out, it's gonna be a taxable event. So we've gotta be careful with that. I generally advise do it at least into the next tax period, so we don't raise a red flag. I prefer to see it be at least 13 months, and if I want absolute safety, I'm gonna say 2 years. The law is not written well. It says intent as opposed to what you're doing. Now, if you go on Facebook and you said, oh, I just did this exchange and I found out I can get money out just by taking a loan, 60 days later, and a savvy IRS or state of California agent looks at that in your audit, you're a toast. You're gonna be paying tax on that boot, because intent is the issue.
And are you hearing anything as far as limitations like that may affect refinances on opportunity zone type?
It's a totally different issue. I don't have the matching of debt issue in 1031 exchanges like I do in the opportunity zones.
Okay.
So I think the biggest risk for Keith is that the capital markets freeze just before he wants to do this refinance. Not through anything Keith does wrong, but something that Donald Trump or one of his people behind him does, or somebody on the Democratic side, whatever bad politician you can think of, that causes the capital markets to freeze inappropriately.
What'll be interesting is if they allow you to refinance early, so you pay all cash for the land, and then you get a construction loan to build it. What do you think the first payment is on a construction loan? A land payment. So you could instantly get your money back in the form of debt, not have it held hostage in the property. Take that money and go do something else with it while the project continues to build out.
And I think that's a risk with pretty much every commercial project right now is interest rate risk and, you know, may not be the capital markets freeze like last time, you know, where everything stopped. But, you know, it may be rates are just too high and the economics don't make sense on the refinance or, you know, any of those types of things can happen. And, you know, with financing right now, you're seeing a lot of it at, you know, 5-year rates or 5-year terms and, you know, 7 years. If you're lucky right now, it seems like, unless you're doing real big stuff, that you get better financing terms. But, you know, getting 10-year even terms is real hard when banks don't want to take the interest rate risk right now, depending on how big a size the asset is, of course, and what kind of loans you're getting. But are you guys seeing anything right now coming down the pipe? Like, what changes do you guys see already that may be coming law in the near future or down the line that they may adjust with regard to this? Are you guys hearing any chatter or anything that's happening right now? That's a tough question.
Well, we know that there's a lot of groups, interest groups that have submitted comments to the IRS. For example, the Real Estate Roundtable submitted a 10-page comment letter, it was last month, and there are other groups who've done the same thing. So our hope is that they look at those and because they have an interest in promoting this, that they do adopt some of the proposals that these groups have put forward.
Sorry to ask you,
No problem, keep asking.
what if you declare you're gonna do an opportunity zone, so you buy a property in an opportunity zone, you declare in the IRS, on your tax form that year, you take your capital gain, you avoid the tax, and then 2 years later, you realize you need to sell the property for whatever reason, some emergency or something. What is like the penalty or the risk there that you take if you sell it early?
Well, there is a reinvestment provision, but it's not well spelled out. So it looks as if you could take the money from the sale and reinvest it in another opportunity zone property. But we don't have the details yet for how that would work.
I think you were talking more about you invested and then 2 years later you gotta sell the property.
And get the cash out.
Yeah, at that point, remember, we deferred the capital gain. At that point in time, whatever money you take out is fully taxable.
Taxable for the capital gain 2 years ago.
Yeah, but it's taxable, or no, whatever you sold it for.
I think
Right.
Peter touched on it earlier. We don't know yet if they look back and charge you the penalty because you should have paid it. But for sure you gotta pay it. You know, you got no step up. The first step up is in year 5, 10%. You
Yeah.
didn't even make that.
I'm saying it would only be the thing, assuming you did all the improvements and you passed the 90% test, and then you sold it 2 years later. Then it's whatever the gain would be. By the way, even if it's, you know, your basis becomes zero, so say you put in $1 million, and then you sell it for $800,000. Well, you pick up $800,000 of income, but previously you got $1 million deferral. Okay, so, you know, that you didn't pick up, so you're picking up 800 instead of $1 million. And that loss is buried in. You know?
What if you don't improve it? So it's like there's 2 cases I guess.
Then you've got risk if you don't improve it and you do it. Now we've got to recapture that income. I'll have to amend the return and I'll have to do it with all sorts of penalties.
The amend the return from 2 years
Yeah,
ago.
yeah.
where you had to capture it.
That's what I'm anticipating. We might have more guidance, but right now, without guidance, that's what I would do.
Who here is looking in California for opportunity zones specifically? Okay, and out of state? Okay, just to kind of understand what's happening, because I would think, you know, like you mentioned, I think the Midwest markets are probably much more viable for this, especially from the cash flow standpoint of these things. You know, you're gonna get a much bigger bang for your buck on improving the value of the property here, but maybe not at the top of the market, and you might have a correction here, and if it doesn't pencil on the cash flow side, you got a big problem, of course. So, you know, you mentioned earlier that you're seeing some cities being very lenient, obviously marketing this stuff and trying to get out there. Would you recommend the first thing you do is, you know, when you find an opportunity, is go see what the city will give you on these things, whether it's tax breaks? I've heard about, you know, really, really low interest or no interest loans on properties and things like that from certain cities that want to have redevelopment happen in a certain area a lot of times. Have you seen anything like that or seen any type of city officials coming out trying to give breaks for this?
In my experience, 25 years is when you go to the city, and it's not what you get from them, it's what they continue to take from you. Okay. So, when I went to Montrose 2 weeks ago, or 3 weeks ago, and I met with the city, and it was completely the opposite, I'm like, oh, hell. What do they tell you? Keep asking until they say no. They never stop saying no. So there's a range of, you know, you're gonna get zero to you're gonna get more than you could ever imagine. So now, yes, any secondary or tertiary market, even a primary market, you don't know what the city's going to give you. And if they want development to come to these areas, they're going to have to participate, whether it's getting committed to shorter turnaround time on, you know, submission of plans and requirements, or the city of Montrose. And here's an example, you know, the answer to every question I asked was yes. So I thought, okay, I'm gonna push this and really see how far. I go, all right, what is Montrose rated as a city? So we're AAA. What I'm going at is, you know, cities, counties, they issue municipal bonds. It's based on their rating. So how much debt do you have now to be AAA? You said, there's only 20,000 people in Montrose. So zero. That's why you're AAA. So you issue $1, can you issue 50 million, can you issue 100 million? I don't know. I go, well, you know, you're still Montrose, Colorado, you've got 20,000 people. This is 700,000 square feet of entitlements that you have approved. You're willing to write a check for $50 million that you're gonna pay for 20% of the infrastructure cost you're gonna give to this development, not lend, you're going to give. No large commercial bank is gonna make a $100 million loan in Montrose, Colorado. Could we access your ability to issue municipal bonds? I think we can do that. The answer is, the answer to the question was always positive. It's either yes, or that was probably the one that was most subject. Let me find out. So it's shocking what some communities will offer you, which is why I'd rather be in the Midwest. You know, and a lot of, you know, major market cities, you're just another guy chasing the same dollar that you're gonna pay, you know, the tax decision price for, not a real estate return price for.
You're building a multifamily project there with mixed use, is that the idea?
It's mixed use, it's multifamily, it's manufacturing.
There's only 20,000 heads, what are you doing? There's only 20,000 population, why are you doing this?
Because the multifamily works, there's no workforce. Montrose is the airport that flies into Telluride. Telluride's very expensive, so there's no workforce housing. So the 300 units of multifamily, easy. In fact, they've already got purchase contracts for both. They hadn't completely finished signing them when I said stop. Because these deals are easy. The hard stuff is convincing some company to move their manufacturing facilities to Montrose. For that, you let the developer take the risk. You take the 2 hotel properties, you take the assisted living, because there isn't any in Montrose. It's only like 30 people over 75. You'll find that in a population of 20,000. You take the workforce housing, and then you go to the city. We've already, that was another question. Are there any city departments that you can rehouse in some of the commercial space that you've entitled? They said, yes, we can move the police department there. Again, the questions just kept coming back, yes. The risk part of it, you know.
But is the idea that your project is gonna enable growth in the community?
Yes, yes.
And I would think, you know, a lot of the community redevelopment things that I've seen in a lot of these Midwest markets, you know, you get some real rural, not rural areas, but like lower end type areas that are, you know, very crime ridden and things like that. You know, obviously, the governors chose these in the regentrification areas, like you mentioned, but a lot of these areas are really low end, and I've seen new housing going up and new stuff going in, but the element not leaving and things like that in some of these areas, just because the city wants to push that doesn't necessarily mean that the population is gonna move, you know, out of those types of areas. So it's definitely a risk from that perspective. And I'd love to just touch really quickly on, you know, some of the major tax changes we're seeing this year, because we're talking about the tax benefits associated with opportunity zones. The biggest challenge you're seeing from a real estate investor standpoint when they're trying to develop any kind of multifamily or big project like this, and what major things to look out for. And then same thing on the syndication side. You know, what are the big mistakes you're seeing people make on the syndication side, and what are the primary issues that people need to, hoops they need to jump through? So I'd love to start, Peter. Can you just kind of touch on some of the big major changes, or what's your thoughts on it?
The only In terms of real estate, there's not much new. I don't know if you realize, there was a new law passed that 20% of taxable income could be a deduction, but it had to be against real trade or business income. And about a month and a half ago, we all got excited thinking that rental property was gonna get this, but be limited to 2.5% of the depreciable assets out there. Well, a new set of regulations just came out about a week ago and totally quashed it for real estate. Unless you're doing something where the real estate's truly a trade or business, like you're living on the property, you're managing it, you're doing work day to day, and you've got no other business, you're not gonna get this 20% deduction. So as an investor, you're probably gonna lose, okay? So that's the only thing we're seeing, but that basically puts us back to where we were before, okay? Rental income has all the advantages and disadvantages it had before, other than the fact our tax rates went down a little bit. I'm not seeing a lot really happen with the new tax laws in terms of the real estate side.
Well, the one thing I might add on that, it's not that anybody's done anything wrong, it's that, this 20% deduction, you do get it if you invest in a REIT.
Yes.
And so I represent several commercial lenders who are all converting to REITs so that their investors can take advantage of this 20% deduction on their income. Yeah.
Now, if you're a syndicator, and you've got maybe 30 or 40 investors, you potentially could convert to be a REIT, but you gotta, what is it, 100 people? You have to have 100?
You have to have 100 investors in a REIT, but that's easy. You can just hire a company that will go out and sell 100 investments, basically sell for $1,000. You pay 12% on that $1,000 per year, and a little bit of a fee to administer it, but that's it.
Yeah. So it is possible to convert your syndication to a REIT, but remember, there's the additional cost if you don't have 100 investors. You gotta pay like a firm like that, and that could be enough cost that might change your overall profit percentage to not be so great.
But if you are a full-time real estate investor and it's your primary income source and you're acting as a trade in business, obviously there's so many different strategies that you know, I have, for example, a holding entity with a bunch of stuff in it, a flip entity, and lending entity, and all this stuff all related to real estate. Obviously, each one of those.
But you're not spending enough time in any one of them to be your fundamental pure trader business. I think you're gonna get squashed.
Well, I am personally,
yeah,
but.
you personally.
Yeah.
It would have to be somebody who's doing a small hotel, that's gonna qualify. Somebody who's got a 20-unit apartment building, they live in the apartment building, and they're managing the building all day long, they're doing all their own repairs, that would be it. They could do it, And by the way, these regulations, they're still cemented in silly putty, okay? So, but just know, what we thought was a good deal has kind of gone away.
Interesting. Okay, any other questions? Anybody in the audience? Okay, cool. What do you think are the biggest mistakes you're seeing in a lot of operations and a lot of the different people that are investing in real estate right now? Maybe from a passive investment side and then also from an active investor side that you see are the biggest risks at this time of the market to investing? This is a very loaded question and you're like, great, there's like 1,000 things people would make mistakes on. But what are you seeing right now that is, I guess maybe it's the biggest risk to you, and then what issues passive investors are having or what they should look out for when they're investing in passive opportunities like you present?
So this isn't an opportunity zone question. This is just real
Correct.
estate.
This is real estate in general because it relates, obviously, as we were talking about, it's more important on the asset than the opportunity zone in the first place, right? So.
You know what, and again, you're right, there's 1,000 answers because every market in the country is different. I compare the US to a thermostat on the wall. What's the temperature? The US isn't all the same temperature in every city. So different cities have recovered at different paces. Asset classes within those cities have recovered at different paces. Some are fully priced, others haven't even begun to grow. You look at where jobs are being created, and there's a sequence of assets as to when they start to move based on the number of jobs that are being created. So there's an infinite number of answers to that question. So it's where are the opportunities? And we're looking, and it's all really job growth related to, the millennials and the tech market.
Market analysis first, then basically is the first thing you're looking at.
Absolutely. Most people are lemmings. They follow the crowds, which means you're daily $1 short. So what you want to look at is where, what they used to say about Wayne Gretzky, why was he such a great, hockey player? He didn't skate to the puck, he skated to where the puck was going, right? So where's the market going and what drives it? Well, it starts with job creation. So we like markets like Salt Lake City, as an example, Nashville, Tennessee. Other people are thinking New York. Well, New York's pretty pricey. San Francisco's pretty pricey. There's opportunities in the Bay Area, but they're in Oakland because there are opportunities in us now. They're in Oakland because, there's price and value across the bridge because rents are 50%. If you want just a general safe market, find some of these secondary markets that are attracting the young millennial worker because it's a live, work, play kind of environment. And, again, the big mistake that's being made is people are following the old traditional markets that are priced out.
Yeah, it's the numbers first. In a lot of these Midwest markets, you get a much higher cap rate on your dollar figure. You can improve, you don't get the bang for your buck on the improvement dollar because, you go improve something that has, you increase rents by $500 a month in California and your value of your building goes up much more, but, the cash flow isn't as good on your cost basis compared to these Midwest markets where you're literally going through and improving for the cash flow specifically, not necessarily you want that built-in equity, but also for that cash flow. What is your thoughts, Catherine, as far as, some of the biggest mistakes you see new syndicators and, operators trying to do on, the syndication side or capital raising side when they're looking at these opportunities?
Well, okay, first of all, I would say, what you were talking about, I would definitely agree with, but on the syndicator side, the biggest, I would say, what do they do wrong? It's, where are they gonna find their investors? This is a big problem. People, they have these big plans to build these projects that it's quite difficult to find the investors. And one of the issues that I face a lot with my clients is they say, well, can I just pay people to bring investors to me? Can I pay the finder's fees? And the answer is no, you're not legally allowed to pay finder's fees to introduce you to investors if you are a syndicator, unless they are a registered broker-dealer. And there are penalties that apply not only to the person you pay the money to, but that apply to you as the syndicator. And one of those is the fact that investors have a right to rescind their investment under California law if they were sold an investment by a person who's an unregistered broker-dealer. So I always tell people to be extremely careful about that, and that of course makes it harder for them to find investors.
All right, we're gonna go ahead and end it here. So first of all, let me get a big round of applause for our panel. So a few things, as we mentioned, as soon as we're done here, we do have the patio over at North Italia rented out. When you leave, if you go behind this wall, there's a hallway and there's a door and then there's a second door. If you go through that door, there's a stairwell that will kind of take you around the back, so you don't have to walk all the way to the front of the building and then back to North Italia.
Can I just say something? I wanted to thank both of you for inviting us. And this has been a very good panel for me for another reason. You don't realize, you've got two world-class people here, okay? Kathy, internationally raising money in China, international raising of money in this. Keith, personally oversees $3.5 billion in funds that he manages. His company is $11 billion. This guy is known throughout the whole country, actually internationally as well with your China investments. These are people that we were lucky to get them on our panel. You know, these large conventions where they're charging you $200 and $300 a person to attend, these are the types of things they normally speak at. So you guys are very lucky to have them be able to be here. And I feel honored that they both agreed to speak on a panel that I was first invited to speak on. Okay? Thank you.
Cool, so next month, look on Meetup, we'll have a panel on short-term rental investing, and what I will do is I'll get the link that Peter talked about, and maybe we can even get his PowerPoint presentation, and we'll send it out to everyone over on Meetup so you can get his slides. If you have any questions, you know, you're gonna have their contact information, contact them. Thanks so much, we'll see you next month.
Great.
Good. I have